XRP Future Millionaire. It is 8:23 a.m. Eastern Standard Time. It's July 27th, Wednesday, 2022, here in the great state of Michigan. And the Fed is to unveil another big rate hike as signs of economic slowdown grow. So what you need to pay attention to early this morning at 8:23 a.m. is the fact that the markets are somewhat pumping a little bit. You've got, and it's not a terrible pump, but if you look at the past 24 hours, Ethereum, you can see in USDT how it's up 6.49%. Ethereum Classic 13.34% as it's come up from $24. Had a nice pump up in the last couple hours. So I don't know if this is going to be indicative of anything else in the market, but definitely overnight we definitely had a nice little spike. Same thing with Ethereum. It didn't have it like, okay, so Ethereum didn't have the exact same powerful move as Ethereum Classic. But Ethereum definitely came up a little bit. Bounced off of here, came up to about 1477, up to the 200-day. Now, if it does follow Ethereum Classic, Ethereum Classic completed this entire bullish divergence, and now it looks like it could bounce off of here and even go up another level. It honestly does. So I don't know if this is going to be an across-the-board thing with the market. Going to pump real quick before the FOMC meeting, because the last two times we've pumped right before, the day before, the 2 days before, and then right when they announced the rate hike, we dumped. We dumped before and then we pumped. So we dumped coming into today, and all of a sudden a few things are starting to pump, but most of the market is rolling over right now. Matic's up a little bit. So that's why I'm saying some things started popping up overnight. In like the last 15, 16 hours, Matic has jumped off of here as well. It was well below the support, and it jumped up, held support at 76, and now bounced up. And the reason why I showed you those before I came into Bitcoin and XRP is because Bitcoin is at the very bottom of this movement right now. It's trying to hold the 20-day. It's come back above the ascending triangle resistance, which it should be using it as support after a breakout like this. So we're going to see if this uses it as support, and if it does, we still have a chance to come to 22,900. But to me, it kind of seems like the max potential would be 21,670. If we do this properly, we could possibly move up. You see Ethereum Classic and Ethereum that have come up a little bit from here. Ethereum Classic in perspective to where XRP is way up here now on its pattern. So can XRP hold this 20-day, and is this bullish cross going to be something and move into a divergence here later on in the day? It's going to have to happen soon because 2:30 is the Fed meeting. So if something's going to happen, it's going to have to happen now. We have a resistance right here at 3370, a support underneath at 3234, and overhead resistance at 3482. The second underneath support is 3124. So that's what we're looking at. So now let's look at the FOMC. Now let's read this, and then I'm going to let you guys go because I'm busy. Julie's birthday's tomorrow, and there's just a lot of stuff going on over here. But yeah, I started my day off the same way. So join Tom's Army, $9.99 a month. I feel like that message is going unheard. But if you appreciate what I do, if you want to show that extra support, that's the way to do it. You get the Telegram for free. That's something I include. Washington, with the Federal Reserve expected to hike its key interest rates by 0.75 of a percentage point on Wednesday to battle high inflation. And like, what I'm saying is, if they only do 0.75 of a point, of a percentage points, that's 75 basis points. That's 0.75%. It's not enough. The market's already baking in 75 basis points and 100, I believe. Maybe not 100, but they're definitely baking in 75. So if it comes out only 75, I think we're going to pump. Focus will shift to how deeply signs of an economic slowdown have registered with the policymakers. The anticipated increase in the target federal funds rate, the Fed's key tool in trying to lower inflation from a 4-decade high, will bring the U.S. central bank to a mile marker of sorts as it reaches a level of around 2.4%. That is estimated no longer to encourage economic activity. That will represent one of the fastest ever gear changes in U.S. monetary policy. Just over 4 months ago, the policy rate was near zero, and the Fed was buying billions of dollars of bonds each month to help the economic recovery from the blah, 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 blah. But while there has been little progress registered yet in the inflation flight, signs of economic stress are accumulating and raises and raising the stakes for Fed officials as they weigh just how much tighter monetary policy needs to be to slow price increases against the risk that going too far could trigger a recession. Even ahead of this week's two-day policy meeting, the inflation problem was considered so dire that investors placed about a 1 in 4 chance the Fed would surprise markets with a larger 1 percentage point increase in its benchmark overnight interest rates, reminiscent of the hikes used in the early 1980s by then Fed Chair Paul Volcker. As the Fed's impact on the economy becomes more apparent, the issue now is whether it is at risk of overdoing it. Parts of the U.S. bond market are signaling an increased likelihood of recession, with yields on 2-year U.S. Treasury notes now higher than they are for 10-year Treasuries. That's inverted. A possible sign of lost faith in near-term economic growth, and reflecting a possibility the Fed may be forced to cut rates within a relatively short amount of time or span of time. Fears of a selling economy were stoked late on Monday when Walmart Inc., whose massive footprint offers a broad view of consumer behavior, cut its profit outlook and said inflation had pressed shoppers to spend their money on food and fuel instead of higher margin discretionary items like electronics and apparel. General Motors, for its part, said it had eased hiring and delayed planned spending in response to inflation and ahead to against a possible broader slowdown. The U.S. Commerce Department is expected on Thursday to report that gross domestic product grew at a turgid pace in the second quarter. New employment data scheduled to be released next week will show whether robust job creation, considered an important strength of the U.S. economy right now, continued in July. And that's another thing, the job growth, that's another bunch of horse shit. And one reason the jobs are growing is because some people are taking out not only 2 full-time and part-time jobs, but 2 full-time jobs or 3 full-time jobs or 2 full-time jobs and a part-time job, because they can't pay their rent or eat food or, get necessities. But they're counting that as job creation, which is horseshit. Those people don't want to be at 2 full-time jobs. So that number will correct itself. Fed policymakers will not issue new economic projections of their own on Wednesday, but a new policy statement due to be released at 2 p.m. EDT 1800 GMT, and Fed Chair Jerome Powell news conference half an hour later should elaborate on how the central bank views the recent economic data and at least hint of its next steps. So, this is the last part I want to read. That will almost certainly include another interest rate increase at the Fed's next policy meeting in September, with incoming inflation data likely to shape whether officials opt for another 75 basis point increase or scale back to a 0.5 percentage point move. With consumer prices rising at a more than a 9% annual rate as of June, the Fed will not slow the pace of hikes until they are convinced inflation has turned. Ian Chupperson, chief economist at Pantheon Macroeconomics, wrote recently, a number of Fed officials at various points since the start of the year have said they thought inflation had peaked, only to be caught out as prices continue to rise faster. By the Fed's preferred measure, inflation is running at more than 3 times the central bank's 2% annual rate or target, leaving policymakers aligned behind not just the usual 75 basis point hikes, the biggest move since '94, but a promise to continue raising borrowing costs until monthly numbers slow. So the Fed continues its monetary policy tightening in the midst of a slowdown. The average contract rate on a 30-year fixed mortgage has risen from below 3% to above 5.5% on the basis of the Fed's rate hikes so far. For example, and new home sales already have fallen to the lowest level since the start of the pandemic. So it's basically what I wanted you guys to see. This is just a lot of stuff. Here, let's just finish this last part. By the time the Fed's September 2021 meeting, policymakers will have 2 months of additional data in hand on prices, consumer spending, business output, jobs, and other aspects of economy. If inflation does slow before then, that meaning it could clear the way for the Fed to slow down. But how's inflation just going to simply vanish? Investors, as of now, are roughly split over whether that will happen, with data likely to continue pulling in both directions. The U.S. economy is likely to have contracted in the first half of the year, but job growth remains robust. Inflation is leading to record low consumer sentiment, but consumers are still spending, only because right now credit cards are at an all-time high for how much U.S. Citizens have on their credit cards, which means eventually you're not going to have any more credit either. And then what happens? You have high credit, your credit cards are all maxed out, and then you got to pay hundreds or even thousands of dollars just to get back to even there. So how is this really going to work? So Greg Dacko, chief economist at EY Pathinoon wrote this week, the U.S. right now is in a world of paradox. So make sure to hit that motherfucking like button. I appreciate each and every one of you who consistently show the support.